Well, it was a pretty mixed week. Finally, starting to get some data coming in. We're getting some November data, and uh, yeah, retail sales was a miss, and unemployment rate slightly ticking up above expectations. So it does really seem like we are in a slowdown. It's not really accelerating just yet. The market's not too concerned at the moment, but I'm curious to hear what your thoughts are. I still think like we're still a long ways away from having any sort of growth scare, but we could possibly be going there, and that's just something that the odds are just there in a risk-off regime that we do get a growth scare and a prolonged increase in the unemployment rate.
Yeah,
I'm
so
curious to see what your thoughts are.
so obviously the issue here is we're in an environment where growth impulses are not positive, and that all that necessarily means is risk in the economy and the stock market, however you want to formulate it, is to the downside. Now, I think the data that we're getting is obviously insightful. It kind of aligns with our slowdown call from earlier this year, but it's also lagging data, right? Um, it's market moving nonetheless, but it's not going to tell us where we're necessarily going to be in the next month or two. I do think that something to watch here on unemployment, as you were saying, is unemployment surprise to the upside, and it is steadily climbing higher ever since essentially the summer. We've lifted off, we hit new cycle highs, and we've been climbing up ever since. Now, I think another area that you have to pay attention to, outside of obviously just the market and our regime model, is that there is some volatility around number one. We're wrapping up 2025 here. We're going into the end of the year, so things can get pushed around for whatever reason. Um, if it's rebalancing, whatever it may be, shortened lower liquidity, shortened weeks, none all that plays a role here. And we also are approaching the announcement window. I think we'll hear probably in the next 30, 45 days about who the Fed chair pick for 2020 for the Fed chair nomination, sorry, in 2026 is going to be. I do think that there does seem to be this weird situation, especially in the bond market right now, where almost every time Hassett's name is name dropped by Besant or Trump, bonds just do a quick little sell. I don't know, if that's just
Yeah.
coincidence, um, or if it's truly like a real, the market's really scared. We'll see, but I could see why the market gets spooked. Nonetheless, I think that that's probably one of the macro risks leading up to next year that we'll have to watch and play out. All in all, the bonds are at a pivotal point here. TLT is at Momo, so either we're going to hold Momo, bounce from here, or we're going to break down. And Artie, what are you thinking on bonds at the moment?
Yeah, well, it really it I you have a good point with the Hassett, the way that's been affecting bonds. I think there's definitely some of that risk being priced into bonds. And I think that's just that uncertainty of who the next Fed chair is going to be is in bonds at the moment, and we can kind of clearly see that, like you said, whenever Hassett is mentioned as the next Fed chair, bonds tend to sell off, and I think just clearing that out of the way is going to help bonds from here, because at the end of the day, no one really knows what it's going to be like when the next Fed chair is in. No one knows how Hassett is going to talk and formulate his pressers or anything like that, and if he's going to not do a good job of it and actually
Right.
add term premium to bonds, that no one really knows what that's going to be. uh, but in terms of the technical side of things, bonds 100% look good. We're starting to see signs, the actual concrete data of slowdown coming. Obviously, the market prices it in ahead of time, but it it really feels like the odds are in favor of a disinflationary regime. especially what we're seeing in inflation swaps, like you're showing here as well. Um, so yeah, I think odds are definitely in favor for bonds at the moment, and in a way, gold as well. It almost seems like gold is kind of taking away liquidity from bonds. I don't know if there's any science behind that, but I almost feel like gold needs to sell off for bonds to start running.
Yeah, I mean that's a possibility where gold is, as the regime cycles and macro regime cycles, I should say, rotate. You typically go from higher inflationary, lower growth environments or lower growth expectations to lower growth and lower inflationary expectations, which is why gold tends to lead those types of moves. But obviously, that's more of a generalization. Every regime in the market and in the economy is different, so you can't just generalize it simply like that and just say, okay, gold can't rise with bonds, because you could just go back to 2019, 2020 ramp up in bonds and gold into the pandemic, where the economy was slowing well beforehand, and both actually rose in the process. So you can't be so cookie cutter, but I do agree with the scope there, that gold seems to have some momentum, and if it fades, I think that'll probably be very impactful to the price of bonds. But we'll have to see how that plays out. I think on the inflation swap side, at 100%, inflation swaps are doing something that I think they haven't been doing in a very long time. At least, a matter of fact, we can take a look here. I don't think they've shown this type of price action all in the last year. They had inflation swaps haven't been in this position or this structure since Trump won the election in November of last year. And
Yeah.
all this chart's really telling you is that short-term inflation expectations 2 year have fallen below the 10 year, and as this or this swap spread widens, it's essentially just telling you, look, front end inflation expectations are becoming less are just basically going lower and lower, and they're becoming less and less prominent compared to longer term inflation expectations, where, as you can see by the 10 years, it's not like 10 years are ripping, right? 10-year swaps are just going sideways. So the twos falling below tens the way that they are, if this continues, that's a very good sign for disinflation. And I think that's what we've been seeing, and that's why our view on bonds has some sort of has some directional bias here. Number one, it's in a bullish trend, and number two, we're seeing some real repair on the inflation front on the market pricing side of things.
Yeah. And inflation swaps, yeah, they have been breaking down, but it's really not concerning just yet. This isn't something that you see when there's an actual recession being priced in by the market. I think really what we're seeing right now in inflation swaps is these tariff uncertainties and tariff inflationary pressures, which are temporary. Those are now starting to get priced out of inflation over the next 2 years. And that's
Yep.
why we're seeing the 2 year move down a lot more than longer duration. But yeah, it's really not a cause for concern just yet, especially just the way the longer term looks, like the 5 year and the 10 years. Uh, they're they're not showing. They're still above 2% at the end of the day. It's showing more of a normalization, which this is why I'm a bit hopeful on a risk on regime pretty soon.
Yeah,
That's
that's a good point. Basically, you're just saying that, look, tariffs have flowed through the inflation swaps as transitory, which we all kind of knew, right? So tariffs showed up pretty quickly in inflation swaps, and essentially, ever right after September of 24, when Trump's odds started accelerating on the win on winning probabilities rose, as he approached the election day, or as we approached the election day, inflation swaps in the process rallied, especially the short end twos, right, in anticipation of tariffs. And now we're seeing a complete reversal there. Like two swaps are back to pretty much September levels. So they're below election levels. They're below Liberation Day levels. They're below pretty much all that. Um, on the other hand, tens are not below Liberation Day levels, which just goes to show you that long-term inflation expectations are still pretty anchored, but they are low. We're at the lower end of the range, but we're still anchored there. which again goes to your point. It's when we see both these really fall together with twos falling rapidly that you have like that real hardcore growth scare, that complete risk off, and that's where bonds just really do bid unless there's like some sort of again um, inflation driven dilemma like Liberation Day with tariffs or 2022. As you can see, going back to we can go back a little bit and see. 2022 was where markets sold off, economy got pretty hurt, but it was really driven by a real run in front end inflation expectations on just the post pandemic inflationary pressures. So it's when twos are below tens and they're both falling in tandem, and twos obviously decelerating faster, disinflating faster than tens. That typical sign of a growth scare where not only are twos going down, but tens are too. You're not really seeing that right now, which kind of goes back to your point. Like maybe we're setting up for a risk on pivot. And to go back to our regime map, um, we left risk on 10/13, so October 13th. So it's been over 2 months. Funny enough, equities since the risk off pivot have not gone anywhere. Stock Nasdaq is essentially down since our risk off call, and all you've seen in between was a lot of vol. And we are not in risk off anymore, though. We left risk off a couple of weeks ago, or a little bit more than that, right? And since leaving risk on, we are now in a position where we're in a slowdown regime. And a slowdown regime is not as bad as risk off. Risk off is a detrimental regime. It's where pretty much almost everything gets smoked. Slowdown is a mix between risk on and risk off, and this is a good sign. If we can drift up towards risk on, we may have a shot here where you're going to see an environment of this basically expansion where um, growth impulses return to positive territory, where we see our growth index slowly climbing up towards trend momo, and inflation index going bearish. So you get the situation where we could end up in the top left quadrant, an expansionary regime with lower inflation impulses and stronger growth. However, at the moment, that is not the case. We are stuck in a slowdown. And I think that that's probably a main driver for a lot of chop. I mean, just look at Bitcoin. Price looks like hot garbage, but it just, it is reflecting the regime that we're in. We're in a slowdown regime. Price is in a bearish trend, and we're ultimately on the we're failing to break above mid vamp, and it looks like we're actually rolling over, at least as of right now. So price does not look good at all. But that is to be expected in the regime that we're in.
Yeah, absolutely. Like risk assets, even in a slowdown, are just not the play. Slowdown, the way we do it is just sticking to safety assets, sticking to bonds as well, just because when risk comes, it comes quick. And no one knows when these vol events happen or like when the market just flash crashes. It's impossible to predict that. The only thing you can do is just being able to see when the odds of a risk event like that are high. You just need to get prepared. And that's all you can really do is just being prepared for when it comes. If it comes, it might not come. In that case, we don't get hurt as well. Ideally that's how we want to be positioned in a way where you don't get hurt if we go back into risk on, but you also can make money if risk off continues and gets worse.
And speaking of that inflationary dynamic we were just speaking about in the regime map, with inflation impulses falling apart, obviously we did cover inflation swaps, but I think it's important we touch on commodities here too, because it's something interesting is going on here as well. Earlier this week, commodities or GSG basket was at some of the lowest points it's been in at least 6 months, and um, or at least 5 months. And I think something to pay attention to here is GSG was able to lose Momo and Midvamp quite easily in the last, call it, week and a half. If we rebound here and we fail to recapture Momo to the upside, the odds of a trend shift will continue to rise significantly as long as momentum builds under Momo. And if this goes bearish trend and can take out this week's lows, which it seems to have been doing this weird price action where it wicks to new highs weirdly and pulls back to make a higher low and then goes back up again. If commodities can change course here and essentially roll over and break down in a weird way, I think this is probably the dynamic in commodities. Even though we're seeing like the inflation swap situation resolve in favor of bond bulls, the reason bonds have just been this weird lackluster asset the last at least month or in terms of the current regime, last month or so, is primarily due to number one, there being some uncertainty around Fed. I think that's probably, even if it's Hassett, bonds, I think, have sold off quite a bit in anticipation. I think markets expect it to be Hassett at this point. He's continuously brought up in conversation, but we'll see how that plays out. I think resolution there will at least add some clarity. And on the other hand, commodities have been in this bull trend, as you can see by the chart here. And I think that, like, even though they haven't broken out, the fact that they just haven't broken down is one of those things where bonds are almost like in the state of confusion because are you seeing these early signals of an expansionary regime forming where bonds can do well in expansion as well, so don't think that they an expansion is terrible for bonds. It's not an inflationary regime, which is not good, but all in all, you think about it like this, where inflation expectations are falling, but they're not falling at enough of a pace to really incite a growth scare, and they're not falling because of a growth scare. They're again, you're seeing a resolution on swap spreads, in our opinion, mainly at least driven in the short term here by transitory tariff impacts. So you're not necessarily seeing swap spreads fall in tandem with twos and tens both compressing or pancaking on the backs of lower growth expectations. You're really just seeing twos doing a lot of the work, which is still a good sign. The curve should be in a position where twos are always below tens. That's a normal situation. Ever since Trump was elected, twos broke above tens and haven't gone under. And now we're starting to see that curve normalize. So that's a positive development. But unless commodities can roll over two, I think you're kind of just repairing some of the transitory tariff damage, which it doesn't necessarily send bonds lower, but it doesn't give them the juice to really run. And I think commodities rolling over would be something that goes back to what you said earlier, Artie, which possibly takes some steam out of the metals trade. And I think the metals trade or gold has a very strong or high correlation to the metals trade at the moment. So maybe gold sees some follow through selling effects from that. And maybe that's what we need is commodities to roll over, weigh on gold a bit, and give that power for capital rotation back into bonds, and send them higher as long as we can hold Momo here. If bonds break trend and they go bearish, all bets are off.
Yeah. I mean, well, Trump's starting a war with Venezuela now, so oil's probably going to get more expensive. That won't help.
Yeah, I mean, at the same time, uh, surprisingly, so this Venezuela news has it's been in the making, right? Like this isn't just a headline drop overnight.
Yeah.
We've been surrounding Venezuela. I think the U.S. has been surrounding Venezuela now for months. So I think this is somewhat anticipated. And the fact crude oil only finished up the day. I mean, there was a contract roll today. So what do we really finish the day? 1%, 1.25. And we're pretty much at lows, right? We take contract. We just look at spot cash price. We're essentially at 52-week lows here. So it's
Yeah.
actually fascinating. Um, either crude is completely mispriced or the Venezuela situation is not nearly as impactful to prices as maybe everyone initially thinks or thought it would be. And that's good for inflation expectations, to be honest. Because I mean, you're seeing GSG up today, but again, you're not even barely at Momo at this point. You're still down over the last 3 days. So the question now is, does GSG reclaim Momo, go back to mid-vamp, and go higher? And I think that Momo should act as some resistance. It should. And mid-vamp should also be some resistance. And things will progressively get worse for the commodities, the commodity outlook, as long as we stay below Momo. And even if we are able to get above Momo, we do have to clear that mid-vamp level. So there is some strong upside resistance, which I think we need some like crazy news to really send us up and through. It doesn't seem like so far, at least at this point, with all the news being baked in about Venezuela, that that's going to do it.
Yeah. I mean, we're also just getting a bunch of data
It's true.
over the next
CPI,
few
right?
weeks here.
CPI
So,
tomorrow. Yeah, CPI is coming out
yep,
tomorrow. Yep.
CPI tomorrow.
And I think
So
PCE on
there's I'm
PCE on
expecting
Friday.
a lot.
Yeah, yeah.
Yeah. I'm expecting a lot of volatility uh, to inflation related assets. So, especially bonds, I think a lot of volatility in bonds here. This is kind of like a do or die scenario. We got TLT right at Momo, and we've got our first CPI print since September. So it really is do or die for TLT here.
Something I've been noticing on the dollar too, by the way, because I know we don't really cover the dollar too much. It's most of our pretty much all of our models are U.S. based, so the dollar by default is the de facto asset. You're long Nasdaq, you're holding dollars, right? You need dollars, so we just generally are dollar based. But I think something interesting about the dollar here lately is that I'm noticing this weird effect where um, earlier this month or earlier later last month, I'm sorry, the dollar was rallying and sending long bonds up with it. Basically, dollar and bonds were rallying together. And I think what happened is the correlation flipped in the last call it 4 or 5 weeks, where the dollar is now bonds are now negatively correlated to the dollar. So what's going on here is quite simple. The dollar originally was going up on the sense of a growth scare back in November. Dollar up, demand for dollars, negative growth environment. It's typical. But when the dollar's falling like this and the dollar started falling, I think the correlation flipped to the point where like now the dollar's falling not because of of inflation, theoretically. I mean, in theory, yes, the dollar going down is inflationary, but on the idea of more rate cuts. So the dollar starts falling in the anticipation of more rate cuts, which closes interest rate differentials between nations, right? So in a hypothetical scenario, let's just say ECB is at 3 or 2%, and US is at 3%. So 3 and 2, right? US at 3, ECB at 2. If there's a spread there, there's gonna be more demand for dollars than there are for um, for euros, especially if that rate differential is not just on nominal terms, but if you adjust out for inflation rates, if that rate differential is still positive, where you're getting a positive after inflation return or inflation adjusted return, that is more competitive than your native currency, you're going to want dollars. But if those rate cuts basically come to fruition, what's going to happen, and the rest of the world now has to start hiking because maybe they're in different inflationary dynamics. Either way, from one country or the other, that gap between lucrative real yields is narrowing, and it creates less demand for dollars. But that's essentially meaning like there's going to be rate cuts and there's not going to be rate hikes, right? So bonds like that. Now, when the dollar is ripping as it is, it's almost on the sense where we're taking cuts off the curve, or we're essentially reducing cuts off the curve. Now the dollar gets happy, dollar's ripping. Well, that's also going to hurt bonds. So we seem to be in this weird state that I don't know how long this persists, where the lower dollar seems to be better for bond prices at the moment. Weirdly enough, I know it doesn't really seem traditional, but that's where we are at the moment.
Yeah. I think that's going to be highly impacted by CPI tomorrow, just
Probably.
based on where the Fed forward guidance goes from here.
Yeah, and I believe we're not going to get month over month figures tomorrow, from my understanding, because there's no October print. So we're going to just have to assume October prices. I don't think we're going to get official numbers, so it shouldn't show up in the macro base, but there will be some people on X that will back out the October estimated number by taking multi-month averages or whatnot to try and figure out where CPI was last month on a month over month basis. And the only reason why you'd want to do that is you essentially just want to take break CPI down into an aspect and see like how has CPI been moving. It's been rising quite a bit, and ever since Liberation Day, and a lot of this I think is tariff related, at least in the forefront, where you're seeing a resiliency in price cutting due to tariffs, but we know that those are transitory. And disinflation should, based on the swap market, disinflation is expected to return. And I think if we have a cool CPI print tomorrow, Um, maybe the dollar goes down and bonds go up. I'm thinking, but we'll have to see how that plays out. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.